Your bank deposits are no longer legally yours. This is not hyperbole. This is not conspiracy theory. This is legal reality implemented through international banking regulations that reclassify your savings account as an unsecured loan to the bank that can be seized during financial crisis. The bail-in has begun, and your money is now their collateral. Let me show you exactly how the bail-in mechanism operates. Let me walk you through the legal framework that transformed your deposits from protected money into bank assets available for confiscation. And let me explain why this represents the largest legalized wealth transfer system ever created. Because when you understand the legal structure, when you see the implementation timeline, when you recognize the mathematical inevitability of banking crisis, you realize your deposits face systematic confiscation disguised as financial stability policy. The bail-in is not theoretical. The bail-in is systematic wealth confiscation. Every banking crisis in history required resolution through either taxpayer bailouts or depositor losses. Taxpayer bailouts became politically impossible after 2008, when public anger over bank rescue costs created political pressure for alternative crisis resolution mechanisms that protect taxpayers at depositor expense. The bail-in represents systematic replacement of taxpayer bailouts with depositor confiscation through legal reclassification of bank deposits as unsecured creditor obligations rather than customer property held in trust by banking institutions. Traditional banking law treated deposits as customer property that banks held in trust, while paying interest for temporary use. Depositors remained legal owners, while banks acted as trustees with fiduciary obligations to return funds on demand. Modern banking law reclassifies deposits as unsecured loans from customers to banks, where depositors become creditors with no guarantee of repayment during insolvency proceedings. This legal transformation eliminates property rights while creating bank claims over customer funds. The implementation occurred through international coordination between banking regulators who adopted identical legal frameworks simultaneously across major economies to prevent regulatory arbitrage where customers could protect deposits by moving funds to safer jurisdictions. Basel III, banking regulations, mandated bail-in implementation through national legislation that requires banks to maintain minimum capital ratios by converting customer deposits into bank equity during financial stress rather than receiving government rescue funding. The Federal Deposit Insurance Corporation implemented bail-in authority through regulatory interpretation of existing deposit insurance statutes that prioritize banking system stability over individual depositor protection during systemic crisis affecting multiple institutions simultaneously. European Union banking regulations explicitly authorize bail-in procedures through the Bank Recovery and Resolution Directive that requires depositor funds to absorb bank losses before any government intervention can occur during institutional insolvency. Canadian banking law implements bail-in authority through the Bank Act amendments that classify deposits over specific thresholds as available for conversion to bank shares during resolution proceedings without depositor consent or compensation at market rates. The legal mechanism operates through automatic conversion of deposit balances into bank equity shares during insolvency proceedings. Depositors receive bank stock instead of cash withdrawals, while banks avoid bankruptcy through instant recapitalization using customer funds. The conversion ratios depend on bank asset values during crisis periods when market prices reflect distressed conditions rather than normal operating values. Depositors receive shares worth significantly less than original deposit values, while banks obtain fresh capital at depositor expense. The trigger mechanisms include regulatory determination of bank capital adequacy below minimum thresholds, liquidity ratios falling below required levels, or systematic stress affecting multiple institutions, where individual bank stability threatens broader financial system operation. Regulatory authorities possess discretionary power to implement bail-in procedures without advance notice, depositor consent, or judicial review during crisis periods when immediate action is deemed necessary for financial system stability preservation. The exemption thresholds vary by jurisdiction, but typically protect deposits below $100,000 while subjecting larger balances to complete confiscation through equity conversion during banking resolution procedures. Small business deposits face particular vulnerability because operational accounts typically exceed exemption thresholds, while businesses require immediate cash access for payroll, supplier payments, and operational expenses that bank equity shares cannot provide. Retirement accounts face systematic targeting because large balances exceed protection thresholds, while account holders cannot access converted equity shares without significant penalties and tax consequences that compound confiscation losses. International deposits face immediate seizure because foreign account holders lack domestic legal protections, while cross-border enforcement mechanisms prevent funds recovery through foreign court proceedings during banking resolution. The precedent implementation occurred in Cyprus during 2013, when depositors lost 47% of balances over €100,000 through mandatory conversion to bank equity during European Central Bank mandated resolution proceedings. Depositors received bank shares that became worthless within months, while banks recapitalized using confiscated customer funds. The Cyprus precedent established international acceptance of depositor confiscation as legitimate crisis resolution mechanism. The expansion implementation includes systematic legal preparation across major economies through legislative amendments, regulatory framework development, and operational system deployment that enables rapid bail-in execution during future banking crises. The technical infrastructure includes automated systems that can freeze accounts instantly while calculating conversion ratios and implementing equity transfers without human intervention during crisis periods, when speed is essential for successful implementation. Banking agreements now include bail-in disclosure language that customers accept when opening accounts, creating contractual consent for deposit confiscation during insolvency proceedings without additional notification or approval requirements. The international coordination ensures simultaneous implementation across multiple jurisdictions to prevent capital flight, where depositors attempt to protect funds by transferring money to countries without bail-in authority during crisis periods. Central bank cooperation agreements facilitate information sharing and coordinated action during systematic crises, where individual bank failures threaten regional or global financial stability, requiring immediate multilateral response. The justification framework presents bail-in as protecting taxpayers from bank bailout costs, while maintaining financial system stability through private sector loss absorption, rather than government rescue funding that increases sovereign debt levels. But mathematical analysis reveals bail-in transfers bank losses to depositors who had no role in creating banking problems, while bank shareholders and management retain control over institutions recapitalized through customer fund confiscation. The wealth transfer mechanism systematically benefits bank owners and creditors while imposing losses on depositors who provided funding that banks use for speculative activities, generating profits during good times and losses during crisis periods. Risk assessment becomes impossible for depositors because bank financial statements do not reflect off-balance sheet exposures, derivative positions, and interconnected risks that can trigger sudden insolvency, requiring immediate bail-in implementation. Due diligence cannot protect depositors because banking complexity and regulatory secrecy prevent accurate assessment of institutional stability, while bail-in triggers can activate based on systematic conditions beyond individual bank control. Alternative deposit protection strategies face systematic elimination through regulatory pressure on credit unions, community banks, and alternative financial institutions that attempt to provide deposit safety through conservative lending practices and capital management. Insurance companies face similar bail-in authority through policyholder funds that can be seized during insolvency proceedings, while pension funds face asset confiscation through similar legal mechanisms designed to preserve institutional operation at beneficiary expense. The economic implications include systematic elimination of deposit security that historically encouraged savings, investment, and economic development through financial intermediation between savers and borrowers, facilitated by banking institutions. Consumer behavior changes dramatically when deposit safety disappears because rational actors avoid bank deposits when confiscation risk exceeds interest earnings, while seeking alternative store value methods that banks and regulators attempt to restrict. Business operations face systematic disruption when deposit confiscation eliminates working capital access, while equity conversion provides illiquid bank shares that cannot support operational cash flow requirements for payroll and supplier payments. Employment effects cascade through business failures caused by deposit confiscation that eliminates operating capital, while reduced consumer spending results from deposit insecurity that encourages cash hoarding rather than banking system participation. Investment declines systematically when deposit confiscation eliminates savings accumulation that traditionally funded business expansion, home purchases, and long-term economic development through financial system intermediation. The social implications include systematic wealth transfer from middle-class savers to bank shareholders and creditors, while eliminating financial security that enabled retirement planning, education funding, and intergenerational wealth preservation. Retirement security disappears when pension funds and individual retirement accounts face systematic confiscation through bail-in procedures, while Social Security and government pensions face similar threats through sovereign debt crisis resolution mechanisms. Educational funding faces elimination through deposit confiscation that destroys family savings, while student loan availability declines when banking system instability reduces credit availability for educational investment financing. Healthcare access faces restriction when deposit confiscation eliminates savings that families rely upon for medical emergencies, while insurance company bail-in procedures threaten policy values and claims payment capability during systematic crisis. Housing markets collapse when deposit confiscation eliminates down payment savings, while mortgage credit availability disappears during banking system resolution proceedings that prioritize bank recapitalization over lending activity restoration. The resistance mechanisms face systematic legal obstacles because deposit confiscation operates through established regulatory authority rather than legislative process, while court challenges face jurisdictional limitations and emergency powers that suspend normal legal protections. International legal remedies prove ineffective because bail-in implementation occurs through coordinated regulatory action across multiple jurisdictions, while bilateral investment treaties and international law provide insufficient protection for deposit confiscation by domestic banking authorities. Political solutions remain unlikely because bail-in policy serves government interests through elimination of taxpayer bailout costs, while banking industry support ensures regulatory and legislative protection for confiscation mechanisms that transfer private losses to depositors. The timing indicators suggest imminent implementation as banking system stress increases through commercial real estate losses, interest rate exposure, and systematic insolvency that requires resolution through depositor confiscation rather than government rescue funding. Regional bank failures during 2023 provided implementation testing, while larger institutions face similar stress from commercial lending losses, securities portfolio declines, and deposit flight that creates conditions requiring systematic bail-in activation. The mathematical inevitability results from banking system leverage that exceeds available capital, while deposit insurance funds cannot cover systematic failures affecting multiple institutions simultaneously without taxpayer funding that political constraints prevent. Global debt levels create systematic banking stress through sovereign default risks, corporate bankruptcy waves, and household debt service failures that generate bank losses exceeding available capital reserves and deposit insurance coverage. The implementation timeline suggests activation during systematic crisis rather than isolated bank failures, while regulatory preparation indicates coordinated response capability across multiple institutions and jurisdictions simultaneously. The targeting priorities focus on larger deposits and business accounts that provide maximum recapitalization benefit, while exemption thresholds protect smaller depositors politically while generating insufficient capital to resolve banking crisis through small account confiscation alone. The legal protection disappears once bail-in procedures activate because emergency powers suspend normal banking law, while regulatory discretion eliminates judicial review and depositor rights during crisis resolution proceedings. The wealth preservation alternatives face systematic regulatory restriction through precious metals, dealer banking elimination, cryptocurrency exchange pressure, and cash transaction limitations that prevent effective deposit confiscation avoidance. The international implications include systematic elimination of financial privacy and cross-border wealth protection, while coordinated bail-in implementation prevents regulatory arbitrage that historically allowed depositor protection through international diversification. The precedent expansion suggests bail-in application beyond banking through insurance companies, pension funds, and government securities, where similar legal mechanisms enable systematic wealth confiscation during fiscal or monetary crisis resolution. The bail-in represents systematic wealth confiscation disguised as financial stability policy, while protecting bank shareholders and creditors at depositor expense through legal mechanisms that eliminate traditional property rights over bank deposits. Your deposits are no longer yours after the crash because bail-in law transforms customer property into bank assets available for confiscation during insolvency resolution that prioritizes institutional survival over depositor protection. The bail-in begins when systematic banking stress requires resolution through depositor confiscation rather than taxpayer bailouts, while regulatory authority enables immediate wealth transfer without consent, compensation, or legal remedy for affected customers. Mathematical inevitability suggests systematic implementation during coming financial crisis, while legal framework preparation indicates coordinated depositor confiscation across multiple institutions and jurisdictions simultaneously. This is not future possibility. This is current legal reality. Your deposits belong to the bank. The bail-in has begun.